Hi everybody, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, a series of videos exploring the mechanics of cost accounting. This video is called The Challenge of Accounting for Fixed Costs 3, Variable Costing. Okay. So we've already seen two videos that point out some serious problems with absorption costing. And remember, under absorption costing, what we do is we include fixed costs as well as variable costs in our predetermined overhead rate. And the first problem we saw is that might lead us to decline business that actually is profitable. It just looks unprofitable because we're applying so much fixed cost to it that it looks like we're losing money, but it has a positive contribution margin. The second problem that we saw is that if we make inventory that we can't sell, then we tuck fixed costs onto the balance sheet in inventory, and we actually look more profitable by making something that we haven't sold, and we're not. So how do we fix that problem? Well, it's a challenge, as the title of these videos might suggest. The alternative is what is called variable costing, and variable costing is extremely simple. Let me show the set of assumptions that we worked with for the prior two videos. We assumed under absorption costing we had a 300% direct labor rate, and we were considering a job, taking on an additional job that would take 10,000 direct labor dollars. Now that 300% rate came from the assumption that we have 125,000 in fixed overhead and 25,000 in variable overhead, and we were spreading the whole 150,000 over an activity base of 50,000 direct labor dollars, and that's how we got to that rate of 300%. Okay, so here's what we're going to do under variable costing. We are not going to create an overhead rate for fixed overhead. Instead, we are going to expense all of our fixed overhead immediately as it's incurred as a period cost. Okay, so let me go ahead and let's set up our Queen's Cross here. And I'm going to go ahead and make the very first entry, and we're just assuming for simplicity this is a cash business. Our very first entry is going to be to take that $125,000 in fixed overhead and put it into a fixed overhead account on the income statement. Oops, 125. So what have we done here? So what we've done here is we have essentially said, we've pretended that incurring fixed overhead does not give rise to assets. Okay, it's a period cost. It's not a product cost. It's just like SG&A, and I'm even going to put SG&A here because although it'd be probably reported on a separate line as fixed costs of production, we're treating it operationally just like SG&A. We have debited the income statement and expense account instead of doing what we have been doing, which is putting it into our overhead account and then applying it to inventory. All right, so now what we can do, I'm going to actually change colors here just to keep it, well, let's see, yeah, I think that's going to be visible enough. So now we'll switch over to blue just to look at the incremental entries that we're going to make now when we say, hey, what happens when we take on this job and don't sell it? Okay, well, the big thing to remember now is that we only have a variable overhead rate, and it's 50% of our direct labor dollars. That's the only rate that we have. So when we take on this job that has 10,000 direct labor dollars, we are going to credit cash for 10. We're going to put it into work in process. That's exactly the same thing we did before under absorption costing. We are going to then apply overhead. Oh, and let me clarify this a little. There ought to be a V there because we are only treating the variable component of overhead as a product cost. That's the only part that's going to pass through the suspense account, the overhead account, and into work in process. How much is that going to be? Well, we have a 50% rate, and so that's going to be only $5,000. Okay, and so and now, I guess I'd better put in our cost of goods sold account here. And now we can ask, okay, so what's our cost of goods sold account if we're going to sell this for $35,000? So, right, oops, sorry, I meant to do that in blue. There's our $35,000, and we have $35,000 in cash. So now it looks like we are that much richer. But we've got some cost of goods sold. How much is that going to be? Well, we sell this thing for 15 and 15. Okay, so far we're 20 ahead. It looks under variable costing like we do want to take the job that absorption costing made us think we didn't want to. Because remember, absorption costing included another $25,000 in fixed overhead in the reported cost. So it looked like we were losing $5,000. Under variable costing, not so. Now, we're not done because we have to recognize the additional incurrence of variable overhead because of this job, and then adjust cost of goods sold. Well, so our rate, assuming everything goes as projected, our variable overhead rate is $5,000, credit cash, debit variable overhead, and wow! We don't expect any adjustment at all as a result of this job, so we're not going to adjust cost of goods sold, and we're done. And look, we expect to have a $20,000 profit reported for this particular job, right? And our aggregate income is going to go up by 20 because of this job. Why is variable costing so different? It's because, let's use red. Here's this new account, right? We are doing something very different with fixed overhead, and something that's not entirely good. So I've mentioned in this course, not in these videos, but in this course, that often in managerial reporting, we are forced to choose our poison. No system is perfect. What do we want to get wrong? Okay, well, under variable costing, what we choose to get wrong is our aggregate income, because we make frankly, a poor distinction between product and period costs. Because think of what's in this fixed overhead account. This is the money we spend on our equipment that we use to make our goods, on our factory, rent, utilities, managerial, people supervising production. All of those really are costs that ought to be considered as giving rise to the products and services, and so they really ought to go into inventory as assets because they provide us future economic benefit that we're going to recognize when we sell our inventory. So variable costing gets that wrong. And in fact, it gets it so wrong that you can't use variable costing for external financial reporting under GAAP or under international financial reporting standards. You can't use it for tax accounting. You can't use it for government contracting accounting. It's that bad in all those senses. However, it does help us a lot with another issue, which is that it makes sure that we don't turn down a job with a positive contribution margin because it has a negative reported margin under absorption costing, which happens all the time. It also doesn't induce us to build up inventory because building up inventory does not increase your profit under variable costing the way it does under absorption costing, because we never get to tuck our fixed costs in inventory because they never go onto the balance sheet. They go immediately into the income statement as a period cost. There's one more problem that I want to point out that comes from the debits and credits in variable costing, and that is that, if you report a cost to your product managers that's only the variable cost, you run the risk that they are going to only want to charge their customers, say in this case, $16,000 or $17,000, giving them a positive contribution margin, but making the contribution margin so low that you can't possibly generate enough volume to run a profit in the aggregate. So, choose your poison. This is the classic example of an accounting system not having enough dimensions. It's the old two-dimensional map can't represent a three-dimensional Earth problem. Variable costing and absorption costing each get something right, but in exchange they get something wrong, and you need to decide which poison you're willing to swallow. I hope you've found this analysis helpful, and I hope you've enjoyed the series of videos so far. Thanks a lot, and bye-bye.